that it has registered over the years, and more particularly for the financial year ended FY23. As some of you may be aware, this is a joint venture between two very prestigious organizations, groups rather. The Murugappa Group, which is Chennai based, which is a 120-year-old group, and Mitsui Sumitomo Group of Japan, which is the 5th largest insurer and operates in as many as 48 countries across Asia and other parts of the globe. This is a joint venture in which 60% is held by the Murugappa Group and 40% by Mitsui Sumitomo Insurance. And as is reflected there in the bottom of the slide, last year was a particularly a momentous year for Chola MS. Momentous in the sense that this was our 20th year of operations, and also to celebrate 20 years of joint venture with MSR, because the joint venture came into existence almost parallelly with the commencement of the company. It was also momentous because our growth for the year was quite substantive. We grew at about 28%, 27.6% to be precise, as against the industry growth of 16.2%. So which means that the growth is almost 1.6x of industry growth. In an industry where generally several players have had solvency pressures, and many of them operating below 1.65 and 1.7, Chola MS operates with a good, comfortable solvency of over 2 times. Our net worth is about 2,160 crores, which is fairly large and is good enough for us to grow further as we go along. We have handled about 34 million customers. We service about 34 million customers and would have added about 12 million customers during the year. Last year was particular, I said, in growth, because it was not just a wholesome growth, but growth in every line of business. If you look at the fire line of business, we grew at about 33%, when industry grew by about 11%. So it was a growth of almost 3 times the industry growth. Motor, which is a very strong line for Chola MS, we grew almost twice the industry rate at 27. Health, again, is a growing line since COVID. We have grown at about 37%. There we have almost kept pace with the industry growth of about 31%. Chola MS has not been writing crop until last year, and thus you can see that the growth has been there across all major lines. Industry, you will know that between motor and health, 80% of the entire size comes between these two lines. Property is about 12, crop is the balance. Crop, of course, is written more by Agriculture Insurance Corporation these days. As I said, motor is a very dominant business for us. More than about 2/3 of our business comes in from motor. Over the years, you can see that the yellow tag, which represents the commercial lines, has been growing for us. So our intent is also to grow this further. Health, which was at about 7% of the total mix, has now grown to about 10%. PA is a very niche line for us, where we have a good commanding market share. Our intent would also be to grow there. Motor, I said, is a fairly large business for us. This is where we have been stepping on our market share quite substantively. So you can see that we are one amongst the 5 private sector players who has a market share of over 5% in the motor line of business. And as the chart on the right side shows, how the mix is also getting diversified. We were earlier a predominantly commercial vehicle focused insurer, and over the years, especially the last 3 years, you can see that it's now getting into a fairly healthy business mix between two-wheelers, cars and commercial vehicles. And how do we get our business? In terms of our strength, uh, the bancassurance relationships that we have, our agency strength that we have, the corporate agents, the direct business, what we do digitally, all of this, this chart shows as to how this mix has changed over the years. We are a fairly strong player in the bancassurance space. We have our bancassurance relationships with 4 large government-owned banks. Punjab National Bank, Bank of Baroda, Union Bank, Indian Bank are the 4 large public sector banks. Amongst the private sector, we have IndusInd Bank, Tamil Nadu Mercantile, South Indian Bank, and a clutch of other regional banks, Grameen banks, small finance banks. So it's a fairly healthy mix from the bancassurance space. We are a non-bank promoted insurer. What I mean is that we are not an HDFC, Ergo, or an SBI General, or an ICICI, which has a parent as its banker. We are a non-bank promoted. In that sense, we are more similar to a Tata AG or a Bajaj Alliance, and that's where we compete in the bancassurance space. Amongst our corporate agents, several large ones, several housing finance companies. Of course, our own sister company, Chola Finance, is also a corporate agent for us. And we run our own corporate agency company as well, which gives a fairly large proportion of our business. By and large, Chola is a retail play. It's about 85% retail businesses. Only 15% is commercial, and this has been growing as we saw earlier. Our intent is to take this 15% to at least 20 to 22.5% in the near future to bring about a larger balance. Even geographically, we are fairly well spread. Even though we are headquartered in Chennai, you will find that the non-south business is almost 60%. And we have a fairly good share coming in from the northern part. As a retail company, the retail customer growth has been quite strong. It's almost grown 3 times from what it was in 2020 in terms of the number of retail policies that have been sold. To give an idea about how our business comes in, our captive businesses. What we mean by captive businesses is what we get from Chola Finance and from other arms of the Murugappa Group. Plus, we run our own insurance distribution outlets in Tier 3 markets, which we call as the Chola Insurance Express. The 3 put together almost gives us 1/3 of our total business. This provides a very healthy stability, because these are our own channels, captive in that sense, and therefore gives the stability. I talked about the public sector bank tie-ups that we have, and you can see that the volume has been growing with the new bank additions, which is about another 11-12%. And the rest of the other tied channels, IndusInd Bank, of course, is one of the very long-standing channel of about 15 years with us, and this is a growing number. You can see that last year these other tied channels has also grown pretty strongly. We have been focused on adding new distribution partners to the extent that now almost 1/6 of our total business comes in from the book, provides us with a fairly healthy stream of investment income, and in the context of a rising interest rate environment, it augurs well for the future fortunes of the company by way of higher investment income. This chart shows how over the last 3 years our top line has grown. COVID did impact the industry badly from a point of health claims. Chola MS paid almost 450 crores by way of COVID claims in those two waves of the COVID period. The industry itself paid something around 25,000 crores, and our share was about 450 crores. From last year, which again was a COVID impacted year in the first quarter, I mean the FY21-22, the growth was muted at about 10%. This year, 22-23, which was the first normal year of operations after 2 years, we were able to get back to a stronger growth of about 27.8%. Then talking of what we do in terms, I talked about the investment income and the strong investment results. The chart in the bottom shows what is called as the combined operating ratio, which simply means what we make out of the premium that we collect from the customers. What it just shows is that, very much like the industry, for every 100 rupees of premium that is collected from the customer, we actually end up paying 109 either as claims plus what we pay for intermediation in sourcing and in operating expenses. So this is the trend in the industry. So the money, which is what it means, is that at an underwriting level, the industry per se does not make money at this point in time, and it is offset by the investment income to result in an ultimate profit before tax. Chola MS has been investing in technology in its multiple forms to the extent that almost 97-98% of policy issuance happens only digitally, and we extensively use robotic process automation in our processes. Last year, to give an idea, we had two major technological introductions. One is in the area of motor claims, where we used and brought into play artificial intelligence. What this artificial intelligence tool does is that, based on the images of the car that has suffered an accident, the intelligence identifies the damages, the parts that are to be replaced, and then the quantum of labor charges that has to be paid, and all this is done, and the estimate for repair is given out to the garage in a matter of about 5 to 8 minutes. So this means that the garage is able to proceed with the repair of the car almost immediately, resulting in much better improved service for the customer. So this is one of the key introductions, and every month now this is extended to almost about 8 to 9,000 car claims that we pay every month. The second major technological introduction last year was with respect to a wellness app. So the QR code is out there. So any of you, if you point your camera, it will get you into downloading our wellness app, which offers you a good, rich experience of interacting with the company. If you are already a customer, so you could use our services in multiple ways, including policy renewals, policy servicing, claim servicing, all of which can be done. And even if you are not a customer of ours, what we would encourage you to do is to use the wellness features that are there, whereby you could track your own several, say, your daily steps, your health risk assessment, all of which you could do using the QR app. This is settling down fairly well, with almost a good number of our customers using this app fairly regularly. So there have been a number of regulations. This is an industry, and especially over the last 8 to 9 months, the regulator has been fairly active. in promoting growth of the industry as such. Several new regulations have come in. To name a few, for instance, now all insurers have a very high degree of flexibility when it comes to introducing new products. We don't have to go to the regulator for approval, which is a very big development. The regulator has also now brought in, effective April, an overall expense limit cap, giving us the flexibility for our insurers. What is required is reflected in the last column out there. Changes with respect to motor vehicles, changes with the government is also planning a major revamp of the Insurance Act itself. The Insurance Act is almost 90 years old, and many of the provisions contained therein are quite historic. This is a legacy of what the British left us with, and this requires quite a bit of changes. The government is bringing about quite a bit of changes there. Some of the major changes is the ability of insurers to distribute other financial products, and also conversion of a general or a life license into a composite license. What it means is that a life company can also potentially sell non-life products and vice versa. So this is a major change. The draft has already come out. In the monsoon session of Parliament, it could be taken up, and if it is passed, this could well become law and get operational from the beginning of next year. Certain other changes. See, insurance is an industry which largely depends on data, and there the regulator is also planning to set up a data information bureau which can help in mitigating frauds, looking at better methods of customer servicing, have more information on the customer per se, which is also going to be a big major regulatory move. So these are some large changes which are there. So now I think we are more than happy to take your questions.
What was your PAT in FY23 over FY22, and what is your market share?
Market share is about 2.87% market share amongst all multi-line players. Multi-line players means who do all lines of businesses. Here we are not including a single line player who are in health or crop like agriculture insurance. So it's 2.87%, and that market share has also grown because we grew faster than the industry.
What was your PAT?
PAT, see, we have given there even in the press release, our PBT is 264 crores for the year. Yeah. PAT is a normal tax rate, which is 25%, about 200 crores.
Previous year 77%.
And I mean, 70% of your business comes from motor insurance. So, and the rest is health, fire, and other segments. Would you like to, are you looking at growing in the same, I mean in the same proportion, or you are looking at, improving your market share in other segments?
We will be, for instance, now this year in 23-24, we are looking at re-entering the crop insurance space.
Okay.
We have secured reinsurance arrangements for that as well. We will have numbers coming in from crop insurance also in the current year, which will help in reducing and getting a more balanced mix of business across lines.
When did you withdraw from crop insurance?
About 3 years back, we took a pause from the crop insurance business.
Okay.
Some of the operating provisions have also changed over the last 3 years, which has made us have a relook into entry into that space.
So you must be speaking to some state governments for the purpose, right?
We have to compete in tenders. So yeah, it's a tender business, so we need to compete.
So generally, how long does it take to settle your claims?
Yeah, so which varies for different lines of business. For instance, in health, if you have to give a cashless approval, we take about 40 minutes to give a cashless approval. So, and that's all the customer needs, because we settle the claim thereafter to the hospital directly. If it is a reimbursement claim, it takes anywhere between 6 to 7 days normally for a reimbursement claim. Likewise, the end-to-end TAT for a car claim is probably, including the time for repair, is about 10 to 12 days. Including the time for repair.
Is it a fair kind of a time frame, or it is?
I'm saying including, because our approval time, I said, because we use the AI thing, it only takes 20-25 minutes to give the approval. But the car repair needs that time. So we are able to do, which is where we are rated consistently higher with most major OEM programs that we participate in. Some of the programs we've been a part of it for last 15 years or so. We continue to have, for instance, a very healthy market share in the Toyota program, which does a continuous rating.
So you also said that you don't make a profit out of underwriting.
Most companies, I could say, not even a single company, multi-line insurer makes profit at an underwriting level.
So you are more of an investment player, okay?
Even globally it is so, sir. Insurance companies make their money out of the investment corpus, which is where the regulator is focused on bringing the underwriting discipline so that companies at least spend only as much. If 100 rupees is the money collected from customers, they don't end up paying anything more by way of claims and running their own business and what they pay to the intermediaries.
How does it happen? You pay more to that client?
So it is a competitive market. So you have,
For a simple guy like me, how do I understand that? That means, if I give 100 rupees, you give me 200 rupees.
no, it is not that way. Some businesses inherently are, because still price is determined by government, may not be profitable. For instance, motor third party, the price is determined by government and the price has not undergone a revision in the last 3 years. While minimum wages have gone up, all of us have seen. Medical inflation is real. We've seen about 11 to 12. So the money that you pay as compensation to an accident victim keeps going up year after year at a minimum compounded inflation of about 8.5%. But when price doesn't go up, naturally the claims ratio keeps going up. The numerator goes up, denominator keeps the same, so naturally the percentage goes up. And just to give one instance of how it's not, therefore not that insurance itself is a business of subsidy. You pay a premium, and since all of us hope that you don't make a,
But you collect it upfront, you also invest.
which is why the investment corpus comes.
Where is the subsidy?
Which is why the investment corpus comes.
So you are saying medical inflation.
Yeah.
The general perception is that because of the insurance, the medical bills have also gone up. If the insurance was not there, the medical bills will not be there. And once you are insured, the hospitals also charge more. That everything they charge. Where is this? How do you get this?
So, which is where even the government, the regulator, all of them are seized of this problem in bringing a healthy hospital care practices. There, it has got to do with the practices of hospitals. Invariably, you will find that even your kith and kin, when they are to go to a hospital, the first question that will be asked is, are you having insurance? The tariff rates are very different. And that impacts the insurer companies, and this again impacts policyholders. You will find that health insurance premium of most insurers in the last 18 to 24 months has gone. Some of them have increased the premium by about 35, 37, 40% even. In fact, even we had to come with an increase of about 17, 18% in October 22. It is inevitable because ultimately, yes, we have to pay our claims.
So general insurance council can not talk to the hospitals and government and everything.
The hospitals don't have any regulator as such, madam. So while see, there is no governing body for hospitals.
Because the final inflation or the increase in price falls on the customer again. So through the GIC or anyone.
So this is a thing which the industry is trying to work together, but in the absence of a centric regulating entity, so it is what each one of us can possibly do in our one-to-one negotiations with the hospitals.
Like you said, you've invested on technology. How much of your new policies are coming through an app or through a website or something?
We have about 2% of our top line coming in as digital business.
So, the dividends you have been paying it separately since when?
The promoters haven't taken dividends. So while, for instance, to give you, I said that we have a net worth of about 2,160 crores. The promoters haven't taken a dividend.
The Japanese don't want the dividend.
Even the Murugappa group hasn't taken.
When can you expect to take them?
No, I think there it is got to do. When our solvency level perhaps reaches even higher comfortable level, say to give a number, say about 2.5, then perhaps the board will have the comfort to start declaring dividends. You want capital ready to fuel the growth. So after 27% growth, we have had a solvency of 2.01. So we would want to probably continue in that stream, then the capital base has to be healthy. When that grows to a certain level, I guess, we will start looking at, the board will start considering.
So I mentioned about the gross premium, retail premium of 6,400 last week, FY23. What will the extra premium, I mean, additional premium correct?
Accretion is about 1,300 crores, 4,800 to
1,300 crores.
It's all from the new clients or?
I would say that it's a combination of both, because even our existing channels have grown. But by and large, I would say that if you have to say new customers, yes, it will be by and large new customers. In property, yes, companies would have enhanced their asset base. To that extent, the premium would be from an existing client. But I would tend to think that at least 85% would be from new customers, new channels.
So the listing, when is supposed to go? The listing according to the regulator.
Presently, the regulator has not prescribed any guideline as such. There is no mandatory listing. But the regulator has been talking to promoters of companies to keep looking at that path. RBI has done it with respect to banks. So it is quite likely that over the next 3 to 5 years, there could be a requirement from the regulator nudging all promoters to look at IPO as an option.
So this is regarding AI-based estimation of claims.
Yeah.
So how can you ensure that 100%?
Yeah, our track record, the way this AI itself was built is based on running that model on our past base of claims of 100,000, we ran it. Today we can say that it has reached a level of accuracy of about 90 to 93%. It gives the same result as a human would do with respect to assessing the claim. So it has reached that level of efficiency. But still, when it comes to complicated, high intensity accidental claims, yes, there will need to a manual intervention will be required. But 93% accuracy we thought is a fairly good one. And where we are able to put through now about 7,000, 7,500 claims on a monthly basis.
So, motor insurance.